Retail is one of the biggest beneficiaries, particularly the domestic-only department stores. And certainly if you look at the performance of these department stores and retail in general, retail's rallied almost 20% since Q3 earnings here. So that's very much in the stock. The tax celebration is definitely in there. It remains to be seen, though, what companies actually do with that extra cash. Will they continue just to buy back stock and increase dividends and make shareholders, line their pockets, or will they do what Boeing and AT&T and Wells Fargo talked about today, which is investing in people, giving extra bonuses? Remains to be seen.
And of course, that is a big story for the U.S. because everyone wants to see those signs of wage growth, and with the Fed tightening in the background. Let's go and talk about a little bit more of the individual names that you want to own going into 2018. There's a lot of talk about the retail industry trends in general, but and of course the disruption caused by the technology and the advent of e-commerce. But zooming in a little bit more, what are some of the names in the U.S. retail space that you think will do well in 2018?
Sure. Well, I think, in general, you see the tax impact, which is helpful, but then the offset here is the continued shift to omni-channel. All of these companies are being forced to continually invest in digital, and it's a lower margin business. So that shift, in a lot of cases, will offset the tax impact. Some of the winners, though, I think, I've been very optimistic about PVH, which owns Tommy Hilfiger, Calvin Klein. They're expanding in Europe. You see their comps up high singles in Europe, gaining some traction in the States. I think there are other names that you have to look at and just say, okay, you want to own them. Globally, Inditex, of course, is the Zara's parent. And certainly Costco, Lululemon, these are companies that are actually driving positive traffic in their stores and also have, some of their investment already behind them.
So you raise an interesting point there. You're saying that actually you want to reward the companies that still attract traffic to their stores, their physical stores, and have less of an online presence. Is the online presence eating into margins that much?
It is. So, a great example last night, so Bed Bath & Beyond reported, and they're an example of they've been a bit of a laggard, and they're just really in an investment phase. They're offering free shipping, they're offering a lot of discounting, and that is bringing down their overall operating margin. You're seeing that in general in retail. Some of the retailers, invested earlier than others. Certainly Walmart has taken the big hit. I would look at Target also now. They're really investing in digital, revamping their stores, and certainly if that pays off for them in the long term, that's an interesting stock to look at 15 times versus Walmart at 21 times.